From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, May 13th, and you're listening to the Macrocast, brought to you by Hamilton Place Strategies and Market Policy Partners. I'm Bryan DeAngelis, a partner here at HPS, and I'm filling in today for Tony Fratto. I'm joined, as always, on the show by John Fagan and Brendan Walsh from Market Policy Partners. Guys, great to be back co-hosting this week.
Yeah, it's our all Massachusetts lineup.
I love it. It was such a ugly week that I was a little tempted to say, let's just scrap it and talk Celtics and Bruins, and we'll come back when there's some better news to bring to folks. But I guess there's too much to cover. We woke up this morning, at least I woke up this morning, with Elon Musk messing around again with anyone who owns some Twitter stock. He seemed to be out, then he was back in. It's paused, it's unpaused. But I kind of am reluctant to start there, but I feel like we have to. So maybe if you guys, like, what's your thoughts on what he's doing, but more importantly, how this is just, it feels like another bomb being thrown into a rough week.
Yeah, and I think that context is important, Brian. It really is as if investors need any more volatility these days. You know, we've got the NASDAQ down over 27% year to date. That's horrendous. And that is, you know, many of the most popular stocks, and certainly the high flying tech, the tech frontiers, really disgorging even more of their outsized profits. I mean, upside over the last few years. It really is it's a challenging environment, and into that arena wades Elon Musk.
Right.
So he was, the temporary suspension of the deal appeared to be centered around his request for more information on the percentage of fake accounts on Twitter. The company's management, I guess, has published 5% as the figure, which I guess Elon thinks is low. So.
Interesting. Yeah. And besides that, it was kind of an ugly week. It was a week where I avoided checking my Robinhood app or any other results, but seems largely driven by fear that just the inflation concerns are still high. Seems like the market is just predicting that Powell will have to bring us into some kind of recession to get out of this. Am I reading that right, or what's your take on it?
Yeah, the markets certainly seem to be reflecting growth. They're caught between, growth and inflation concerns. That's your stagflationary dynamic, which is really problematic. You have the yield curve in the treasuries not really knowing where to go. You obviously have the front end pushed higher by expectations of Fed hawkishness and rate hikes expeditiously, as Chair Powell said. But the reality is, how much further can they really go? At this point, and so with expectations of growth slowing down, some indications of demand coming off, and so you get that back end of the yield curve where all the action is, that 10-year, 30-year. It's like, is it going to respond to inflation and go higher, or is it going to respond to growth concerns and go lower? And that's kind of the tug of war that we're seeing.
You also had a situation where on Wednesday, the CPI report was coming out. So that was the big event of the day, of the whole week, actually, probably of the month also. But you had a number of large Wall Street banks put out reports saying that they believe that March was the peak in inflation, and that their future projections were too high, and that inflation is going to come off, not fall off a cliff, but it was going to moderate quicker than they had expected. Yeah. So you had a market that was expecting a CPI print that was going to come in lower than expectations. So the fact that it came in, even just in line, if not a little higher on the core reading, you had a market that was offside. People thought, okay, this is a bottom picking opportunity, and then the numbers came in worse. Then you had the next day followed by the PPI. So honestly, in terms of like the way markets work, it probably was the best thing to happen, where the market thought it was ready to buy the low. It might not have been. And then you had a very much a capitulation event this week where you just had an indiscriminate selling across the board. And then also, John, equity markets are fun to talk about. You know, they go up and down. But I thought the most interesting market of the week was the Treasury market.
Yeah, you know, and that really is the, you know, when you have that dynamic of investors really being caught between the inflation concerns, growth concerns, these are blending together. And so we had seen, you know, the 10-year yield, you know, and the longer dated yields shooting up to, you know, these multi-year highs, and the 10-year getting over 3%. But then in this kind of, you know, these have a self-limiting dynamic in some ways, you'd say, right? The higher the Treasury yields, the more risk off the dynamics get, and people flee back into longer dated Treasuries.
It's like circular reasoning. It was a bad inflation print. The yields have to go higher, so they immediately spiked, and then they were above 3, and they're like, oh my God, we're going to choke off growth. So then people pile back into Treasuries and yields go down.
Yeah.
And then when you see yields go down, the equities investors are like, oh, yields are lower. Let's buy textiles.
Yeah.
Garbled.
On the inflation front, so it seems like no cliff in sight. Just going back to what you said, Brennan, like, you know,
there are
pretty much like March.
We've probably seen the peak in inflation, but I mean, it was an enormous peak. But I do think that these data showed that it's going to be a little stickier than we hope. Yeah. I think we will moderate. Also, I mean, just simply the base effects. Things have spiked so much. Like gas prices are, you know, $4.30 a barrel. A gallon. That's quite high, but they're not, knock on wood, going to go to $9. We're going to kind of stay in this level. So the month over month change, and then also going forward, the year over year change is going to moderate. We also had some quirky things. Airline fares were up 18%. So now airline fares are back to where they were pre-pandemic. So we'll find a moderation here in airline fares. Yeah. So that one component added 1/10 to the month over month change. So if airline fares had been normal, the other thing is used car prices have started to come off. The Manheim index has it down over 1%. But the BLS changed the way that they measure it, and they only had it down 1/4. So there are deflationary forces coming in.
Yeah.
The worry is the rent component is remaining sticky. So that will going forward be a big contributor to it. But
I was just going to ask you about housing. There's rent, and then just the housing market in general is just changing, right? Interest rates going up much higher, supply is going down.
So that's an interesting dynamic for the Fed, because the way that we measure housing is we measure just rent if you're rental, but also if you own your house, we don't measure, your house went up 12% from $100,000 to $112,000. We measure it how much you can rent it for. So all of our housing is based on rent. And so the 30-year is well above 5%. It's doubled in a couple months. We are seeing a slowdown in new buying activity. We also know that we have a massive shortage of housing. So that's a dynamic where rent can stay elevated, because we're not building anything new. That then, as a policymaker, is a little bit of a conundrum where, we kind of do it in a quirky manner. And if you're going to very, very much focus, we're at, we're at 4.5%, but a lot of that is because rent is sticky, and a lot of that is because we don't have the supply. Is it best to keep raising rates and put us in recession, which will then, drive rents down, or maybe stay steady and try to help people build new houses?
Yeah, I mean, the European Central Bank has made that distinction a lot. That distinction between inflation, that's a supply shock that is taxing on growth. That sort of balanced approach, and we're looking at, but policymakers are really in a tough spot here. The Fed has focused very much, has said growth is strong enough to withstand considerably, higher interest rates, and that's the way in which we're headed. But they are noting things like the China lockdowns, and there's this sense that those shock waves have yet to really hit the numbers, hit the economy. We're seeing, more selective price increases, like gasoline futures hit all-time high this morning.
Yep.
And so
this
is all, the potential to have another inflationary wave. But it looks like that wave might be washing ashore with lighter demand pull, I think, as the economy gives a cyclical slowdown here.
Yeah, I mean, if you can't get an Apple computer because Shanghai's locked down, I'm not exactly sure what the Fed raising, 75 basis points is going to do to exacerbate, or it will exacerbate that situation, maybe.
Yeah, and just a last point on this, when you look at market-based gauges of inflation expectations, the TIPS market.
I wanted to get to this. So maybe fully explain this. This is a really important point.
Yeah, so this is basically the Treasury inflation protected securities are when you subtract the yields that they give from the regular yielding treasuries, that's your market-based indicator of what expectations among investors in this asset class are thinking will be where inflation is. And if it's 5 years and 10 years are usually what they look at, but those are kind of stylized. That's more like medium term and long term. Don't take necessarily the years literally. And those have, when you look at the 5 years had the biggest swing. I mean, this topped out at 3.73% in March of this year. That is a very lofty number, but it's notably lower now at 2.91%. The 10-year has moved a little bit less. It topped out at just over 3%, and now it's 2.63. These are coming off the tops, pretty significantly.
Yeah, and it really happened this week. If you look at the chart, it looks like a cliff.
Yeah, and when you look at the industrial metals, for instance, which aren't experiencing the same kind of supply shock that other commodities are, well, those prices are down a lot. And that has, something to do with, global growth, in particular, sort of Chinese property sector growth. So it's inflation and these kind of supply shock dynamics are getting, more diffuse. And that's, I think, eventually the Fed has to contend with that. But right now they're still, at hike as much as we can from
right. Let me before we take I know we need to take a break, but before we get there, let me just ask you about the Fed. So I don't think it was a big surprise, but Powell did get confirmed this week, 80 votes. Seems like we're going to have the full Fed team in place here fairly quickly. Is this just non-news to the markets or a little bit of reinsurance? I mean, they've got a lot of work ahead of them.
Yeah, I think it's the baseline where the market was. There weren't the expectations out of line with what happened. And so, everybody's got the Fed is pretty unified now. And even if you're, putting additional, the new members coming on, it's really a very unified policy stance. Even the doves sound pretty hawkish these days. And, the differences in, more about the sort of 75 basis points versus 50 basis points. It's not splitting hairs, but there is not wide dispersion of policy views on the committee at this point.
Yeah. Well, great. Let's take a short break there. We've got the other big news of the week. If you're following the crypto markets at all, just ugly week. So we'll come back in a minute and talk more about that. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com. or visit them on Twitter @MarketsPolicy.
We're back on the Macrocast. This is Bryan DeAngelis filling in for Tony Fratto this week and with John and Brendan of Market Policy Partners, as always. Guys, the other big news, and I think very related news to the market volatility we talked about in the first segment, was just an ugly week for crypto. We saw a major crash, a death spiral, if you will, of a stable coin, Terra and Luna, which really what we saw, they just lost their peg to the dollar. It just over Wednesday, I think it was Wednesday and Thursday, just, really started to fall apart. At one point, they had to halt the blockchain. At one point, then they tried to kind of restart it. And I think at this point, it's somewhat safe to say Luna is dead, and we'll see where things are going. But, this started to have, real ripple effects. We saw Tether lose its peg to the dollar, another stable coin, one of the largest stable coins. This coincided with Yellen up in front of House Financial Services Committee talking about some of the FSOC risks. So very timely in that sense. But, it was there's a lot, as you guys know, and we've talked about and worked on, happening in Washington right now around crypto regulation, crypto stablecoin. This was a big week for that, and just create a lot of attention back on this. So I'm curious for you guys. I think this, the crypto sort of follows the markets a little bit, but then at some point this week, I think the markets had to kind of react to this crypto crash because it's a lot of the same players. But let me get your take on how this all went down.
Yeah, the crypto volatility this week definitely spilled over into the NASDAQ, into the cryptocurrency involved and cryptocurrency adjacent tech companies. We saw, outsized declines in NASDAQ coinciding with this turbulence in crypto. It really is, essentially the mainstreaming of crypto. It's a process, not an event, but it has negatives and positives. I think that we've seen this as potentially an example that, as you get bigger and more mainstream, and you're going to draw the attention of some pretty big, mean players potentially on Wall Street. Yeah. There's some pretty sharp people out there that are interested in making a big arb. And if you're an easy target, if you're a weak wildebeest, then maybe you're the speculative kind of attack. And that's what this is kind of being characterized as a speculative attack, being compared to George Soros's attack on the pound way back when. And that is, those compared, they've also made sort of breathless comparisons to this being crypto's Lehman moment. The reality is, this is part of what it means, and to be a more mainstream asset class. And when you have things like the market, the physics of financial markets aren't suspended, indefinitely for crypto, and stable coins are a peg, and there's nothing more speculators like to attack than a peg, particularly if your peg is wobbly. Yeah, right. And the idea of you need backing, obviously the assets to back that peg up. But those assets have to be, those have to be trusted. They have to be transparent. And usually the operator has to have some kind of track record for those to be really credible and hold up under the kind of stress that we saw this week. And obviously, I
think that's the key point here, right? Like personally, I'm pretty sold on crypto, right? I'm a big believer in the technology behind it, and I do see the future use cases in a lot of respects. But a lot of these coins at the same time, it is based on market confidence. It is based on speculation. And when you lose that, you end up in one of these death spirals. And when we don't have a regulatory framework to kind of manage any of that, you're just left with really a race to the end and some big moments. So I think this is a crypto winter moment. I think there will be a lot of lessons learned coming out of this. I don't think this is a moment to say crypto is dead, but I do think you're going to see, you saw it with Yellen, but the pressure now, if it wasn't there already, has just ramped up big time on SEC and others. I do want to ask, my formative years in politics and economics was 2008, right? Chris Dodd hired me a few weeks before, this all started in March 2008, and then it was just a ride. This is not 2008 to me. And with all due respect to friends in the media, I don't know if it's just an easy comparison and some quick, lazy reporting or what, but I see a lot of differences between the two. Am I wrong on that?
Yeah, there are a lot of differences, and obviously things can change over the course of time here. But as it currently stands, Treasury Secretary Yellen made this key distinction: orderly markets. We've seen two-way market price action. Obviously, overall the trend is down; it's not been positive, but it hasn't been panicky, crashy, gappy kind of price action. You get a couple of down days, and you get a rebound, and that's what is supposed to happen. And policymakers have been previously had been increasingly nervous that asset values might be getting out of hand. This is, in some ways quite a relief to them. And
you got to keep things in perspective. The S&P and the NASDAQ and a lot of these stocks are back to where they were right before the pandemic started.
Right.
Everything puked.
Right.
We handed out $5
trillion. What a crazy couple of years.
Yeah, we handed out $5 trillion. We stayed home and did nothing. And then we also pumped in a massive amount of monetary stimulus.
And we didn't stay home and did nothing, right?
It found its way into things, and now it's kind of finding its way out of it, and we're back to where we started. It's not. Crypto is maybe a little different. We have.
I think there's a good
1.7 trillion in crypto. The whole subprime losses were 1.3 trillion.
Yeah.
What I do worry about is a huge amount of retail bought fairly close to the highs in the crypto market. So there could be some pain there, but it's not systemic in my opinion.
Well, that's what I was going to say. I mean, in some ways, we didn't do nothing over the last 2 years. A lot of us, rightly or wrongly, smartly or not smartly, downloaded the crypto apps, downloaded Robinhood. We took our extra cash. We started becoming amateur retail investors and all of this stuff. Probably bought a lot of this stuff at highs, right? It's become
well, an NFT was listed for $25 million and it sold for $115, and that 115 is probably too high.
Right. And so there's going to be some pain, and I think that's my take on this is a long view, which is just there are going to be growing pains like this if this industry and this ecosystem is going to stick around. And
like 2000.
I don't know how many coins are up to, but they won't all be here in 5 years.
But 2000, 2001, that wasn't the end of tech.
That's right.
Adjustable rate mortgages. We still have adjustable rate mortgages, but now you have
coming
to
back,
do a background check, and you have to, at least put something down. I think it's similar with the crypto market. There will be crypto. I'd imagine Bitcoin and Ethereum, will exist in the future. I don't know what it'll be worth, but I don't think a lot of these other small coins are gonna make it. And also there's a lot of stable coins that aren't stable.
And even though the size of the crypto market is large, it's hard to shake the foundations because institutional investors aren't really all that into it, right? And so you don't have big allocations to it. It is seen as a very risky and sort of niche part of the portfolio still. And so when you don't have those vectors into the foundations of the financial system and the major players and the too big to fail crowd, it's hard to have these losses in the crypto world translate into something that's really systemic. You can't rule out like that kind of snowballing panic kind of pro-cyclical dynamic that can happen, but and
it's still young, right? A lot of these guys are still figuring it out. I mean, I watched guest after guest on CNBC the last 2 days of like, listen, I'm not buying, but I'm not going to short it right now. I have no idea what's going to happen.
Yeah, I mean, and the stable coins really are, our view from Markets Policy Partners since the end of last year was really that crypto would still remain a patchwork. They were going to struggle to have any sort of motion toward a comprehensive crypto bill and regulatory approach, and so we think it's still this patchwork. The Gensler, obviously, the SEC is intent on blanketing them with securities regulation. The Treasury wants tax compliance, anti-money laundering, and consumer protection as part of it as well. I mean, these are things that they want to achieve, but the high priority that we've always flagged is the stable coin. And this is, the events this week, I think, really put an emphasis on that, an exclamation point at the end of the need for some regulation. And Janet Yellen talking about these are money market funds, right? These are money market mutual funds.
Yeah, because the crypto crowd always said, we're crypto, we're not a financial product. And if you ask the question, the response was, you don't get it. Coinbase just had their earnings, and in it they had to disclose that in the event of bankruptcy, if you your assets held at Coinbase you would be a creditor. So
yep.
you're it's not just like depositing money at the Bank of America, where if Bank of America was bankrupt, you got all your money
I can
back.
still get all my dollars back. Yeah.
Yeah. Coinbase, you would get maybe none of your crypto back.
Yeah. Right. Well, let's take a let's take a break there. There's probably hours more conversation we could have, but we'll come back, and Brendan, maybe you can give us a view on what to look for ahead next week, or anything we missed in this wild week. But we'll be right back on the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
We're back on the Macrocast. This is Bryan DeAngelis filling in for Tony Fratto, as always with Brendan and John from Market Policy Partners. Brendan, are we going to have as ugly a week next week as we saw this week?
Well, on the data front, it's much more quiet. It's actually a big week for China. There's a number of important data points out, but also the PBOC has a decision on their loan prime rate, which is essentially their Fed funds rate.
Yeah.
At the last meeting, they've held it steady, but China just this week had a default. One of the fourth largest real estate developer was unable to pay one of their bonds. So there is a lot of pain in the Chinese housing market, and a lot of it also is somewhat self-inflicted, but with the new lockdowns. And then the U.S. has a number of housing data out, but the big report from next week will be the U.S. retail sales.
Great. Anything else we missed from this week, or should we just get ready for our Celtics Bruins, hopefully, finales?
Go Bruins. All
right. Well, thanks, guys. I appreciate you letting me jump in here and take the wheel this week. For all our listeners, thanks, as always, for tuning in to the Macrocast. I'm Bryan DeAngelis with Hamilton Place Strategies. Thanks again to John Fagan and Brendan Walsh of Market Policy Partners. Hope everyone has a great weekend, and we'll see you back next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.